Intercompany transfer of assets. Upstream sale of depreciable equipment, year 2. And under year 2, we're going to look at the equity method of accounting and the consolidation accounting. There's not a lot of activity that is different but from year 1, so we'll combine them into one learning objective. We've got the net income, dividends, and we'll focus on the special allocation items, which in year 2, or X8, is depreciation. Here's the information for income, and we can see that we've allocated those out for the net income and the dividends. That leads us to the excess depreciation entry under the equity method. And remember, no one can be better or worse off because of the transaction, and the depreciation between the parent and the sub for this asset differ. And we can see that they differ by $7,500, and we're short $7,500, so we need to increase depreciation expense by $7,500. So during the year, to do that, we're going to debit income from subsidiary, credit the investment for $7,500 times 80%, and that represents the parent's ownership interest. We recap everything, we get the following, and we can see that in our income reconciliation we increase depreciation expense by $7,500, which in turn reduces income from subsidiary. We get our book value calculations and our investment reconciliation, along with our NCI reconciliation. And we can now begin the consolidation process. And the EJEs, the first 3 I'm going to go through rather quickly. If you want to look at those a little closer, you can look at the PowerPoint slides which have them in there. We've got the current year activity between the parent and the sub, the current year activity between the NCI and the sub, the subsidiary's equity, and then the EJEs that we're going to spend a little time on are any special allocation items, and this is the equity method entries that we made during the year. We need to eliminate those, and this was the entry we made to record the excess depreciation. One thing we have to remember on an upstream transaction is that when we make this elimination, we must also assign the NCI their portion of the item. So this entry here, we made the same entry in year X1. We'll continue to make this entry in X2, 3, 4, 5, 6, and 7 as long as we hold the asset. So we'll need to make this each and every year for the next couple of years. The next thing we need to do is look at the deferred gain or loss, and we must properly reflect the revenues and expenses as well as any assets that we have. We know that we have a deferred loss, and we know that the equipment is understated, so we need to bring it up to its correct value. And a good starting point is, what did we do last year? This was the entry we made last year. We stated the equipment up to its correct value, we recorded the accumulated depreciation to its correct value, and we deferred the loss. Well, where do revenue and expense accounts go once they close out? They're going to go to the investment subsidiary account and the NCI account. So we'll take any revenue and expense accounts that we have, in this case the loss, and we're going to allocate that loss out 80% to the parent, 20% to the NCI. The 2 asset accounts will remain the same, the equipment and the accumulated depreciation. The same thing holds for depreciation. What did we do with depreciation last year? We recorded it to depreciation expense. So where do revenue and expense accounts go once they close out? in our example, and always when it's upstream, the investment account and the NCI. Remember, this is what we did last year to bring the depreciation to its correct value of $22,500. We debited depreciation expense, credited accumulated depreciation. This is a good starting point for us to go forward in X8, and we know that revenue and expense accounts close out to investment in the NCI, so we'd make the following entry in X8. This is very similar to what we did on the downstream transaction. The only difference is on downstream 100% went to the investment subsidiary account. On the upstream, it's going to be allocated out between the investment subsidiary account and the NCI account. We clean it up, it looks like this. And the last thing we need to address is the current year depreciation expense. So the prior EJE handled what we did before. This one is going to address the current year shortfall. So we'll debit depreciation expense, credit accumulated depreciation. We recap everything. We get the following. We get the excess for the equity method entry number 4, the assignment of the deferred loss, and number 5. Number 6 is the assignment of the prior year depreciation, and 7 is the current year depreciation.